The Bank of Canada just held rates, like I said in my last video, and almost everyone's blaming inflation, and they're half right. But the real reason they couldn't cut showed up 2 days before the announcement in a single jobs report nobody saw coming. In May, Canada added 88,000 jobs, not 8,000, not 18, 88,000, when economists were expecting around 10,000. That one number quietly killed the rate cut conversation. And today I'm going to show you exactly why, and the question that actually matters for your mortgage and your wallets. Will it last? Here's the rules of the video. We're not doing hype. We're not doing a spin. I'm walking you through 4 things: the number that broke the rate cut argument, why it happened and whether it's real, the crack underneath it that nobody's really talking about, and what all of it actually does for your mortgage and the housing market. And at the end of the video, I'm going to touch on a program that we're implementing that can make it so you don't really have to care what the Bank of Canada does. So let's get into all of it. Let's start with the headline, because it's genuinely stunning. For the first 4 months of the year, Canada bled jobs. As mentioned in my last video, 112,000 gone between January and April. That weakness is exactly what fed that emergency cut crowd and that emergency cut conversation. Then in May, we printed 88,000 jobs. The single month reversed almost 80% of the entire year's losses. And it was the first real gain since November. But here's the detail that actually matters, and the one that a lot of headlines are skipping right now. This wasn't the usual crappy composition. In most positive prints, you dig in and it's all part-time or government jobs. Not this time. Full-time work rose by 154,000. Part-time actually fell by around 66,000, and the private sector did 56,000 of its own, not the government. And that full-time number nearly erases that 156,000 full-time jobs in Canada that were lost over the first 4 months. So this wasn't soft. It was the real thing. So what does this mean? Well, central banks don't cut aggressively into a labor market that's adding full-time private sector jobs while unemployment falls. It dropped from about 6.9 down to 6.6%. You don't pour gasoline onto a fire that's raging. That's why the cut you were kind of waiting for didn't come. Now, the question I actually care about, and the one your mortgage depends on, is this real, or is it just 1 month of good news before a whole bunch more bad news? Let's look at where these jobs actually came from, because the composition tells you whether it's going to stick or not. The biggest gain was in construction, up 27,000. And here's the honest read on that. A chunk of it is seasonal work. May is the start of construction season. Workers come back from spring layoffs. Layer on government infrastructure spending and a massive wave of purpose-built rentals getting built across the country, and you get a real but partly temporary bump in employment. Then transportation and warehousing is up about 19,000. Recreation and culture up another 19,000. Food and accommodations up about 17,000. Some of this is genuine, but I think some of this could just be one-time noise, big summer events, and seasonal hiring. And there's a quieter reason that unemployment looks better that has nothing to do with jobs. The math underneath it. Canada is adding far fewer people now. Immigration has been cut hard. When you stop adding workers to the denominator, the unemployment rate can fall even without much real strength. Mark Carney himself tied the slowdown to lower immigration, which is an admission that a lot of our past growth was just stacking more consumers into our economy. Here's the honest verdict. 1 strong month is not a trend. When you get a couple of brutal negative prints earlier this year, that is a trend. I'm not going to flip and call 1 good month a recovery. This is a weak labor market that bounced hard, partly real, partly seasonal, partly a math illusion, which the next print, if it holds, the rate cut door stays shut. If it folds, the conversation can change again and we start talking about cuts again. But here's where I'm going to give you something that most of the headlines completely miss. Because under the strong number, there's a crack, and it's sitting right next to your wallet. Wholesale and retail trade lost 35,000 jobs in May. And that one matters more than the gains. Construction is the build side of the economy. It's further from your day-to-day. Retail is the consumer. When retail sheds jobs while construction is booming, that's not a healthy economy. That's a K-shaped one. two halves splitting apart. Now, stack wages on top. Wage growth cooled from 4.5% down to 3% year over year. And inflation is still ripping. It'll likely climb and continue climbing because of the Iran-US conflict and the cost of oil, which is bleeding into everything from transportation to groceries to everything. And when you run the math on your life, if your pay grows by 3% and your cost of living outpaces that, you're not getting richer, you're getting poorer in real time, while the economy is telling you it's doing the strong. And the group that should scare you most is the young people. Youth unemployment is still massively elevated, sitting north of 13%. These are your future first-time homebuyers, and they're getting delayed, and the starting line is getting further and further away. Your average first-time homebuyer in Canada right now is pushing 40 years old. When young people can't get stable work, they can't save, they can't qualify, they can't move out of their parents' house, and the entire housing cycle pushes out years. Not to mention, if they can leave our country or leave the province or their city to find gainful employment, that doesn't help either. The last thing we want is educated young people in Canada going, hey, I'm out because I can't get a goddamn job. Right now, the economy is strong enough that the Bank of Canada won't rescue you, but cracked enough that you still feel squeezed every single month. That's where we come into stagflation, and it's the worst possible backdrop for someone waiting on rates to fix their life. So let's bring this all the way back down to you specifically, because this whole jobs report is really a housing story in disguise. Here's the trap it creates. Because employment is holding up, almost nobody is being forced to sell, right? That's a good thing. The number one reason people miss mortgage payments is losing a job, and that's not happening at scale. No forced selling means no flood of cheap listings, but affordability is still broken. So there aren't enough buyers to drive a recovery either. Put those together and you get exactly what we have. A frozen market that's just grinding sideways. Not a crash, not a boom, a slow, agonizing crawl. And that can last years. So if your entire plan is to wait for rates to drop and the market to free up and all these good things to happen, this report just told you that that plan is broken. The rescue isn't coming because the economy isn't weak enough to force it. Now, here's where I'm going to give you a tool that I think changes the script and interrupts the entire pattern. What if I told you you could take a 5-year fixed and then refinance later at lower rates if they come available without having to pay massive penalties to do so? Now, we already know that the charter banks, RBC, CIBC, Bank of Montreal, they have really big gross penalties. But we know there's also a ton of other lenders that do not have these big penalties. And that's where we say, instead of sitting there waiting for some magical thing to happen to fix the market and make it the perfect time to buy, explore your situation right now. Explore whether it makes sense right now and act accordingly. Because you're not marrying an interest rate for the entirety of your life. It's 3 to 5 years, guys. It's not that long. And on top of that, let's say you take a 5-year fix and 3 years into it, rates hit the floor, you can refinance and access that. And if you work with specific lenders, not only is the penalty lower, we may be able to enroll you in our penalty protection plan, where half of your penalty, up to $5,000, could be covered if it makes financial sense for you to move to another lender to access lower interest rates. Now, if you want more information on that program, there's a link down in the description below. You can book a call with me and my team. We can take a look at mortgage options and what everything kind of looks like and let you know if you can enroll in something like that. Because I firmly believe that when you get a mortgage, you shouldn't be locked down. You shouldn't be put in a proverbial headlock with that lender. You should be able to make changes and assess and shift as things come available and as the market shifts. It gives you flexibility. It gives you the ability to look at the market now and say, hey, this isn't forever. Now, if you've stuck around to the end and you got value out of this, do me that huge favor, hit that like and subscribe button so more people like you can see this video. And if you have questions about that program I just mentioned, drop them in the comment below or book a time with our team. We'll walk you through all the details. And if you have questions about the market, put them down below as well. I read every single one, try and get as much useful information to people as possible, because I want to make sure that you don't make mistakes and that you can pay yourself more. My name is Myles Nowik, owner of the Nowik Mortgage Team, powered by Indy Mortgage. Thanks so much for tuning in. We'll catch you on the next one.